Okay, dear students, let's start another live revision class for SBR March 25 session. IAS 12. Income taxes. Okay. Number one concept, that is the concept of under provision of taxation. Now, what do you mean by under provision of taxation? Basically, organizations, they do not pay tax on accounting profit. Tax is actually paid on taxable profit. So actually, what do we do? We convert accounting profit through adjustment to the taxable profit. Through adjustments, we convert accounting profit to the taxable profit. Taxable profit into tax rate, you get current tax payable. I'm just assuming it is $20,000. This is your corporate income tax payable. Let's say in 2024, the current tax payable is 20,000. Debit and credit. December 24, the double entry is current tax expense debit by 20,000. Your tax payable, current tax payable. Current tax payable credited by 20,000. Now, normally what happens that 2024 tax will not be paid in 2024, it will be paid in 2025. And actual tax payment you will get to know when you are paying. Let's say scenario number A, assuming we are making payment, I'm just assuming that during 2025, your taxation authorities, they are asking to pay them your tax payment is actually 23,000. Even though in 2024 we recognize the tax payable 20, but when the time came for the payment, actual payment relating to 2024 is 23,000. Now, what will be the double entry in 2025? That is very important. Debit, credit. Your current tax payable will be debited by 20,000. Current tax payable. Okay, just a minute. Students are one student is unable to log in. Why? Current tax payable is debited by 20. Bank credited by 23,000. Now this 3,000, which is under provision because we recognize 20. Actually, we had to pay 23. Simply your income tax expense. Logically, this 3,000 is under provision. Now, what under provision does? Under provision of taxation increases current year. Current year means in my example 2025. Increases current year income tax expense. Without having any impact on current tax payable. Obviously, in 2025, when you will be converting accounting profit to the taxable profit, and then taxable profit of 2025 multiplied by tax rate, you will get current tax payable of 2025. Under provision will not have any impact on the current tax payable of 2025, but under provision increases the current year, that is in my example 2025, income tax expense will increase. Now, in B, there's a possibility of over provision as well. Let's say during 2005, let's say the taxation authorities, they've asked just pay us 16,000. Even though we recognize previously 2000 in 2024 20, but let's say taxation authorities, they are saying your liability is only 16 relating to 2024. So tax paid is 16. Now listen, if in 2024 we recognize the current tax payable 20,000, but actual payment in 2025 is 16. It means previously we have recognized over provision. Now what over provision does, over provision will reduce your income tax expense of the current year, again without having any impact on the current year income tax liability. Now what will be the double entry of this 16,000 debit and credit? Current tax payable is 20. Let's say the taxation authorities, they're saying just pay us 16,000 relating to your 2024 tax. Okay. Now in 2025, your income tax expense will be reduced. So let me repeat, over provision, what it does, over provision actually reduces your current year income tax expense. Okay, now let's go ahead. We have one profit is accounting profit. Let's say accounting profit multiplied by tax rate. I'm just assuming this is 40,000. But the point is, we do not pay tax on accounting profit. Tax is actually paid on taxable profit. Okay. So through adjustments, what do? We convert accounting profit to the taxable profit. Let's say taxable profit multiplied by tax rate, I'm getting 45,000. Now listen and listen carefully. Accounting profit multiplied by tax rate, I'm getting something else. Taxable profit multiplied by tax rate, I'm getting a different result. Technically, logically, the difference between these two taxation here, which is 5,000. This 5,000 is deferred tax. The question is why deferred tax arises. Deferred tax could be deferred tax liability, could be deferred tax asset. We will discuss both of them. A very basic reason of deferred taxation is taxation on the basis of accounting profit is different as compared to taxation on the basis of taxable profit. So the difference between these two gives rise to the deferred tax. Now another concept. If due to taxation rules, in the current year, your company has saved the tax. If due to taxation rules, we are saving the tax in the current year, it means that we'll be paying more tax in the future. When we'll be paying more tax in the future, it means we should be recognizing a deferred tax liability in our books. Deferred tax liability means organization will be paying more tax in the future. Another scenario, if due to taxation rules in the current year, your company has paid more tax. Let's say your taxable profit is only 1 lakh, but your accounting profit is 60,000. It means when that accounting profit through adjustment we converted into taxable, so taxable was more than accounting profit. So if taxable profit is more than accounting profit, I'll be paying more tax. So if in the current year company pays more tax, it means in the future company is going to save tax. When in the future company is going to save tax, then we'll be recognizing a deferred tax asset. So deferred tax liability means company will be paying more tax in the future. Deferred tax asset means company will be saving tax in the future. Now there's one question. If company pays less tax in the current year than more tax in the future, so we'll be recognizing a deferred tax liability. If company is paying more tax in the current year than less tax in the future, it means logically deferred tax will arise due to temporary differences. The difference is a temporary difference. It's a timing difference. So deferred tax, either deferred tax liability or deferred tax asset, deferred tax only arises from temporary differences, timing differences. That is timing differences. Okay. According to IAS 12, there are two types of temporary differences. One is taxable temporary difference. Another is deductible temporary difference. Taxable temporary difference multiplied by tax rate gives you deferred tax liability. Deductible temporary difference multiplied by tax rate gives us deferred tax asset. Now, a very important point, deferred tax liability means company will be paying more tax in the future. Deferred tax asset means company will be saving tax in the future. So there's a question. Do we need to discount deferred tax liability and deferred tax asset? The answer is no. We do not discount them. The question is why we are not discounting them, because even though when you are saying deferred tax liability means more tax in the future. So if it relates to future, normally whenever we are recognizing a future value, first we convert that future value to the present value, then we recognize it. So why we are not discounting deferred tax liability and deferred tax asset? There's one reason. The reason is when we say deferred tax liability means more tax in the future, exactly when we'll be paying more tax, we don't know. Deferred tax asset means you will be saving tax in the future. Exactly when I'm going to save the tax, we don't know. So exact time period, we have no idea at all. That is why we cannot discount. If you just recall present value of decommissioning cost, so we exactly know that at the end of useful life of the asset, we are going to dismantle the plant. So we need to discount it. So here, the exact future timing we don't know. That is why we cannot discount. Just 1 minute break. Azan is sounding. Okay. And there is one more reason of not discounting the deferred tax liability and deferred tax asset. It is also possible in 2025, your company has recognized a deferred tax liability. In 2026, there's a possibility company might be having a deferred tax asset. So simply these are the reasons. That is why we are not discounting deferred tax liability and deferred tax asset. Now, how do we get taxable temporary differences? How do we get deductible temporary differences? There's one concept. After that, you will be able to know how do we get these differences. The name of the concept is tax base. Actually, tax base means according to taxation authorities, what is the value of your company's assets or liabilities? So tax base means what value taxation authorities, they assign to your assets, or in case of your liability, what value they assign to your liabilities. So tax base means what is the value of your assets or your liabilities, but according to taxation authorities, that is tax base. Okay. Now, in case of assets, if carrying amount is more than the tax base, the difference is going to be taxable temporary difference. In case of assets, if carrying amount means net book value, carrying amount means which is written in SOFP. If carrying amount is less, tax base is more. The difference is a deductible difference. And we know that deductible temporary difference multiplied by tax rate gives you deferred tax asset. Now, this relationship, as compared in the relationship in liabilities, is exactly opposite of assets. In case of liabilities, carrying amount means which is written in SOFP. If carrying amount is more, tax base is less. Now, instead of taxable temporary difference, you will have deductible temporary difference. In case of assets, if carrying amount is less and tax base is more, difference is a taxable temporary difference. Okay, now there are number of assets and number of liabilities where the tax base is universally same, no change at all. So you need to know all this. Tax base, like land, the tax base of the land is the original cost of the land. Okay. Property, plant and equipment, depreciable asset. Tax base is the tax written down value. Investment, tax base is the original cost of your investment. Provision, any kind of provision, let's say provision for dismantling cost. Tax base is zero because taxation authorities do not accept provision as your liability. Even if organization is having a provision for doubtful debts, tax base is zero. Okay, now let's talk about the relationship between IAS 12 and IFRS 16 leases. And one more, stock, tax base is the cost. We know that in case of a stock, obviously on a stock, on inventory, we apply IAS 2. According to IAS 2, inventory is measured at lower of cost or NRV, whichever is lower. But taxation authorities do not accept your NRV. According to the taxation authorities, the tax base of the stock is cost. Okay. Now, there are few relationship between IAS 12 and other IFRS and IESs, which you need to know. One is IAS 12 and IFRS 16 leases. Okay, let's see. What is the relationship? Carrying amount, tax base, temporary difference. Okay, IAS 12, IFRS 16 leases. When it comes to lessee, lessee means the one who is actually the company which is utilizing the asset. Lessee is the organization which actually uses this asset. And the entire relationship is between IAS 12 and IFRS 16. And in 16, the relationship is with the accounting of lessee. Now, what lessee does? Lessee recognizes right of use asset. So obviously in lessee's books, there will be a carrying amount of right of use asset. Now listen carefully. Taxation authorities, they do not accept a right of use asset as your asset. If they're not accepting right of use asset as an asset, so then simply tax base is zero. So right of use asset will always have a tax base zero, always. So obviously right of use asset is an asset. Having carrying amount more, tax base less, the difference is a taxable temporary difference. Taxable. So right of use asset will always result in taxable temporary difference. Lease obligation. Obviously, in lessee's books, there will be lease obligation as well. Now listen carefully. Taxation authorities do not accept lease obligation as lessee's liability. So taxation authorities, they are not accepting lease obligation as an obligation. When the taxation authorities, they are not accepting lease obligation as your obligation, tax base will be zero. But now this time, the difference will be a deductible difference. Normally, deductible differences, in order to differentiate from taxable, we write them negative. So deductible differences we write in negative so that they should be differentiated from taxable. So this is deductible temporary difference. And deductible temporary difference multiplied by tax rate will give us deferred tax asset. The main concept is, the main relationship is, in case of right of use asset, tax base will always be zero. And there will be always a taxable temporary difference. In case of lease obligation, tax base will always be zero and there will always be a deductible temporary difference. And now listen, there is no such concept that this taxable difference and deductible will be same, will be equal. There's no such concept. They could be equal, they could be different. If you ask me, most of the time they will be different. The concept is the right of use asset will result in a taxable temporary difference and lease obligation will result in a deductible temporary difference. The concept is tax base of right of use asset will always be zero because taxation authorities, they're not accepting right of use asset as asset. Lease obligation tax base will always be zero because taxation authorities, they're not accepting lease obligation as your obligation. Now, if I just give you one more idea relating to this, statement of comprehensive income. We know that, let's say, lessee has charged depreciation expense on right of use asset. We know that if at the end of the lease term, ownership title is transferred to the lessee, then right of use asset will be depreciated over the useful life of the lease asset. Otherwise, it will be depreciated over the lower of useful life and lease term. So depreciation expense on right of use asset, let's say lessee has deducted. Finance cost on lease, that will be deducted from associate. I'm just assuming that we are having a profit before tax. I'm assuming 500 million. Now listen, we know that we are not going to pay tax on accounting profit. This 500 is the accounting profit. Logically, tax is paid on taxable profit. So what are we going to do? When we'll be converting this accounting profit to the taxable profit, so we add back depreciation expense on right of use asset. We also add back finance cost on lease. Add back. But taxation authorities, they do accept rental payment as your expense. So you will only deduct less rental paid. Lease rental paid will be deducted. Lease rental paid will be deducted. So you just need to know few things. In case of right of use asset, tax base will always be zero. Lease obligation tax base will always be zero. Due to right of use asset, there will be a taxable difference. Due to lease obligation, there will be a deductible temporary difference. And we know that taxable temporary difference into tax rate gives us deferred tax liability. Deductible into tax rate gives us deferred tax asset. But obviously, when we are solving a question, there will be number of taxable and deductible differences. First, we have to net off all the differences. If the final net difference is taxable, then deferred tax liability will be recognized. If final answer is a deductible temporary difference, then deferred tax asset will be recognized. IAS 12 plus IFRS 3. Business combination consolidation. So students, here I have to take 20 minutes prayer break. Within 20 minutes, inshallah, we'll resume the class. Before resuming the class, I'll drop the message in the respective WhatsApp groups. Please just give me 20 minutes. Let me pause the video. Student, let's discuss another relationship between IAS 12 and IFRS 3. Business combination. Basically, it is a requirement of IFRS 3. At acquisition, you have to bring all the net asset of subsidiary at their fair value. Now, the fair value adjustment is the difference of two things. One, the carrying amount in the individual books of subsidiary, and fair value at acquisition date. The difference is the fair value adjustment. According to IAS 12, any deferred taxation which is arising from fair value adjustment, impact of that deferred tax goes to the goodwill. So simply, assuming property, plant and equipment in subsidiaries individual books is having a carrying amount of 100 million, but the fair value is, let's say, 140 at acquisition. So obviously this 40 million is a fair value adjustment. Okay. Now, due to this fair value adjustment, deferred tax liability will arise, and the deferred tax liability which arises because of the fair value adjustment, the impact that will affect the goodwill. So here, deferred tax liability which will arise from fair value adjustment. Assuming 40 into tax rate is 30%, let's say it is 12. That 12 million will increase the consolidated goodwill, will increase the. Now, why it will increase the consolidated goodwill? Basically, when we are acquiring a subsidiary, so net asset of subsidiary at acquisition, they will increase by 40 million, but they will also reduce by 12 million. Of course, that deferred tax liability which arises because of this fair value adjustment will reduce the net asset at acquisition. And when the net asset at acquisition will be reduced by this 12 million, so automatically the goodwill increase. Because goodwill is the difference of two things. One is your investment minus the fair value of net asset acquired at acquisition. And obviously, when we say parents investment, we do include NCI as well. Okay. So you just need to know one thing, that is the goodwill which arises from fair value adjustment, it affects the deferred taxation which arises from the fair value adjustment, it affects the goodwill. Okay, now one more thing. That is intra-group trading of goods. Either parent is selling goods to the subsidiary or subsidiary selling to the goods to parent, or one subsidiary selling goods to another subsidiary. Okay. We know that in group accounts, we will eliminate unrealized profit on a stock. On a stock will be eliminated. In group accounts, unrealized profit on inventory, unrealized profit on stock will be eliminated. Now what happens in group accounts? We have eliminated the unrealized profit from the stock. So carrying amount, tax base, temporary difference, inventory. Assuming after eliminating the unrealized profit from the stock, the carrying amount is 10. In group accounts, the carrying amount of the stock will be after eliminating the unrealized profit on a stock. But tax base will be the purchase price for the buyer. Tax base is the purchase price for the buyer. Let's say buyer has paid 12 million. So there will be a deductible difference. Multiply by tax rate, there will be deferred tax asset. Now listen carefully. Always in group accounts, due to unrealized profit, there will be a deductible difference, and due to deductible difference, there will be a deferred tax asset in group accounts. And one more thing, we know that unrealized profit is always in the remaining stock. Obviously, the stock which we have sold, so the profit is realized. So unrealized profit is always within the remaining stock, in the unsold stock. So you just need to know one thing, that is, due to unrealized profit on stock, in group accounts, there will always be a deductible difference, and due to deductible difference, we recognize deferred tax asset. Okay, now. IAS 12 plus, let's say, IAS 16, property, plant, and equipment. Assuming there's a land, carrying amount is 120 million, tax base. We know that in case of land, tax base is the cost of that land. Assuming the cost of that land is 100. Let's say this land was purchased for 100, but company follows revaluation model. So they have revalued during there. So in the current year, they have recognized a 20 million revaluation surplus. So the carrying amount is 120, tax base is 100. In case of land, tax base is the cost of the land. Okay. Temporary difference. Carrying amount is 120, tax base is 100. So there is a taxable difference of 20. Taxable temporary difference. Now, before this, let's say in the current year, they have recognized a revaluation surplus of 20. The double entry of that 20 is land is debited by 20, revaluation surplus slash OCI is credited by 20. Let's say the tax rate is 30%, so there's a deferred tax liability of 6 million. Now listen carefully. This is a taxable temporary difference of 20 million, but logically this difference of 20 is arising due to revaluation surplus. According to IAS 12 deferred tax, if your deferred taxation is arising from revaluation surplus, then it will be charged to revaluation. Or you can say that when your deferred tax arises from an equity item, then it will be charged to equity. So simply, during the current year, the first entry was, let's say, land debit by 20. revaluation surplus slash OCI credit by 20. But always remember one point. Due to revaluation, there will always be a taxable temporary difference, and tax rate multiplied by taxable temporary difference gives you a deferred tax liability. When your deferred tax liability arises from taxable temporary difference, if according to IAS 12, if your deferred tax liability is arising from an equity item, then it is charged to equity. So simply we will debit the revaluation surplus. Six, credit the deferred tax liability. So please don't forget the concept. When deferred tax arises from an equity item, then it is charged to equity. Okay. Let's go ahead. Plus IFRS 2. Share-based payment. Okay. We know that when we say IFRS 2, so the scope of in IFRS 2 scope, we have three type of transaction. One is equity settled share-based payment transaction. Second is cash settled, and the last one is optional. There's a relationship between IAS 12 and IFRS 2. In IFRS 2, the area is equity settled share-based payment transactions. Okay. Now, what happens in equity settled share-based payment transactions? Carrying amount, tax base, temporary difference. Share-based payment. Now, please listen carefully. Obviously, against the share option scheme, employees, they will be providing services to the organization. Repeat. Against the share option scheme, employees, they will provide services to the organization. Services of our employees, our own employees, they are valuable asset for us. But only the problem is the services which companies taking from their employees, we cannot assign any value to those services. Actually, we cannot recognize the services as an asset. Simply, you can say the services for our employees, they are an asset for the company, but having the carrying amount zero. Basically, the services which we are taking from our employees, I cannot capitalize them. So simply these services, they are having carrying amount zero. But according to the taxation authorities, there is a tax base. When those employees, they are in share option schemes, according to the taxation authorities, number one, taxation authorities, they basically treat employee services as an asset, and they do provide value to that asset as well. According to the taxation authorities, tax base will always be equal to the intrinsic value. Repeat. Tax base will always be equal to the intrinsic value. Okay, students. Can you tell me quickly that intrinsic value is the difference of which two things? Intrinsic value. Tax base is equal to intrinsic value. Multiply by, we multiply this with, let's say the vesting period, I'm assuming vesting period is 3 years, okay? Divided by 3. If 1 year has been passed, then 1 upon 3. If 2 years have been passed, then 2 upon 3. If 3 years have been passed, 3 upon 3. So tax base is equal to intrinsic value. Intrinsic value is equal to fair value of shares minus exercise price. Intrinsic value is equal to fair value of shares minus exercise price. Here it could be 2 by 3. Depends. If I'm solving the question and just 1 year has been passed, then 1 upon 3. If 2 years have been passed, then at the end of second year, 2 upon 3. If 3 years have been passed, then 3 by 3. Intrinsic value, fair value of shares minus exercise price. So according to the taxation authorities, employees, they are providing services to you against the share option scheme. So those services, they are valuable asset, and they do calculate the value of that asset as well. The value of that asset is equal to intrinsic value. But accounts people, they're not accepting that intrinsic value as an asset. So the carrying amount is 0, but tax base is there. There will always be a deductible difference. Deductible difference multiplied by tax rate, you will have deferred tax asset. So what exactly you need to know in case of IAS 12 and IFRS 2? Number one, share-based payment, carrying amount will always be 0. Tax base will always be equal to intrinsic value. And intrinsic value means fair value of shares minus exercise price. The difference will always be a deductible difference, and deductible difference multiplied by tax rate, you will get deferred tax asset. And we know that deferred tax asset means company will be saving tax in the future, and actually tax will only be saved when employee will exercise their option. So in the year in which employees, they will exercise the share option, then tax will be saved. So IAS 12 and IFRS 2 carrying amount will share based payment carrying amount is always 0. Tax base will be equal to intrinsic value. Difference will always be a deductible temporary difference multiplied by tax rate will give you deferred tax asset. Just one more thing which you should know. If and this intrinsic value is a tax allowable expense. If tax allowable expense is equal to less than cumulative remuneration expense, then tax allowable expense multiplied by tax rate, there will always be a deferred tax asset. And impact of that deferred tax asset will always go to P&L. Associate. Simply deferred tax asset will be debit, P&L associate will be credited. But if tax allowable expense is more than cumulative remuneration expense, assuming it is 20 million and it is 16 million, then 16 million into tax rate, deferred tax asset, impact of this deferred tax asset will go to P&L. 4 million multiplied by deferred tax rate, there will be a deferred tax asset. Assuming tax rate is 30%. So 4 into 30, it will give me 1.2. I just want to show you the impact of this 1.2. And let's say take 30 here also. So 16 into 30, that is 4.8. And assuming this is the first year, assuming it is the first year. If it is the first year, logically deferred tax asset will be debited by 6 million. Credit is very interesting. Associate P&L, that is deferred tax income. Actually, what deferred tax income does, it reduces your income tax expense. Deferred tax income reduces your income tax expense by 4.8. Now this 1.2. So according to IAS 12, if tax allowable expense is more than the cumulative remuneration expense, then that excess impact will go to equity. So simply I'll debit the equity. That is OCE, other component of equity, not OCF. OCE will be debited by, or OCE will be credited by 1.3. So repeat, the deferred tax which relates to the X, only that additional amount, that impact goes to other component of equity, OCE. So you just need to know one thing. When tax allowable expense is less than equal to cumulative remuneration expense, then deferred tax asset impact goes to P&L, associate. But if tax allowable expense is more than the cumulative remuneration expense, then only the excess impact additional, like in my example, the excess is 4 million. Then 4 million into tax rate, the impact goes to equity. And this time, logically, deferred tax asset is debited by, let's say, 1.2, and your equity slash OC, other component of equity, is credited by 1.2. Okay. One more thing. Let's say if you have IAS 12 plus IAS 37. Warranty provision, assuming it is 2 million. Carrying amount, tax base, temporary difference. Warranty provision, carrying amount is 2 million. Tax base will always be 0 because taxation authorities do not accept provision as your liability. Multiply by tax rate, there will be a deferred tax asset. Okay. IAS 12 plus IFRS 9. Let's say your company has made an investment in equity instrument. Investment in an equity instrument. Let's say your company has made an investment in equity instrument, means ordinary shares of other company 10 million. And let's say your company is following fair value through P&L category. Number one, under IFRS 9, when your company is making investment in ordinary shares of other company, then default category is fair value through P&L. In exam, nothing is mentioned, just investment in share is written, then we always assume fair value through P&L category. Number one. Number two, fair value through OCI category is possible. Number one, when fair value through OCI category is possible. Number one, when you are making investment in equity instrument of another company, not for short-term trading purposes, number one. And number two, you have to make an irrevocable election. So number one, if you bought the shares of another company, not for short-term trading purposes. Second, your company has made an irrevocable election. After that, fair value through OCI category is possible. Otherwise, it is not possible. Okay, let's say here, this is the investment of fair value through P&L. Assuming we made the investment on this date, December 25, let's say the fair value of investment is now 13 million. So investment fair value through P&L will be debited by 3, and P&L, profit and loss associated, will be credited by 3. Now, December 25, carrying amount, tax base, temporary difference, investment, December 25. Now investment will have a carrying amount 13, but tax base is 10. If you recall, we did discuss in case of investment, tax base is the cost of investment. 3 is a taxable temporary difference. Multiply by tax rate, we'll get deferred tax liability. Let's say the deferred tax, I'm assuming deferred tax liability is 0.9. Now, the double entry of this 0.9 will be deferred tax expense debit. Basically, P&L is debited by 0.9, deferred tax liability is credited by 0.9. Now listen, instead of fair value through P&L category, instead of fair value through P&L category, if this investment was under fair value through OCI category, then instead of debiting the deferred tax expense, instead of debiting P&L, we would have debited OCI. Repeat. Instead of P&L category, if the investment was fair value through OCI category, then again credit will remain same 0.9, but debit will be OCI. Is this clear to everyone, students? In case of fair value through OCI, what happens? Okay, sure. Now listen, a very important announcement, that is again, in today's plan, we had a IFRS 9 as well. Deliberately not discussing today, but now listen the plan carefully. From the coming week onwards, we'll be doing two things. One, of course, we'll be revising IAS 32 as well as IFRS 9, inshallah. Plus, from the coming week, we will start the revision through past paper questions. And at least 3 to 4 days before the class, admin will share the questions with you, which we are going to discuss on Saturday. So every Saturday from coming Saturday onwards, inshallah, we will be revising number of IFRSs, but through past paper questions. And one more thing, if there is any specific topic, which you want that we should revise it in a really good detail, so do mention in the WhatsApp group, in your WhatsApp groups, so we can revise that topic as well. Is this clear to everyone, students? Please comment on that. And plus, after, I would say, 3 more weeks, your test will also start. Okay, admin will start sharing the test as well. So students, thank you very much that you people have taken time to attend today's class. See you all inshallah in the next class as well. Thank you.